Hello everyone. Now I am going to discussing you with the concept risk adjusted discount rate. An estimation of the present value of cash for high risk investment is known as the risk adjusted discount rate. A very common example of risky investment is the real estate. Risk adjusted discount rate is representing the required periodical returns by investors for pulling funds to the specific property. It is generally calculated as a sum of risk-free rate and risk premium. The variation of risk premium is depending on the risk aversion of the investors and the perception of investors about the size of property's investment risk. The use of risk adjusted discount rate is based on the concept that investors demand high returns from the risky project. The required rate of return on any investment should include the compensation for delaying consumption equal to risk-free rate of return plus compensation for any kind of risk taken on. In case the risk associated with any investment project is higher than the risk involved in a similar kind of project, the discount rate is adjusted upward in order to compensate this additional risk borne. So risk adjusted discount rate is a sum of risk free rate and risk premium. I already explained. The risk premium depends on the perception of risk by the investor of a particular investment and the risk aversion of the investors. So risk adjusted discount rate is equal to risk free rate plus risk premium. So the risk adjusted discount rate declared for that by altering the rate depending on possibility of risk of invested or investment projects. For higher risk investment project, a higher rate will be used, and for a lower risk investment project, a lower rate will be used. The net present value is inversely proportional to risk adjusted discount rate, as an increase in adjusted rate will decrease the net present value, representing the task is less acceptable and perceived as riskier one. A rate which would be used to discount the cash flow is the sum of risk-free rate and the compensation for investment risk. Suppose the risk-free rate is 10% and the compensation of investment risk is 5%. Then a rate of 15% will be used for discount cash flow. So risk-free rate is equal to, it is the rate of return on investment that bears no risk. Best example for such is government securities. And the risk premium is the rate of return over and above the risk-free rate expected by the investors as a reward for bearing the extra risk. For high risk project, the risk premium will be high. For low risk project, the risk premium would be lower. Let us discuss the advantages and disadvantages. Advantages are the plus points of adjusted rate is it is easy to understand and it is quite simple. Risk adjusted rate has a good deal of intuitive appeal in the eyes of risk averse business person, and it integrates an attitude towards uncertainties. Therefore, it incorporates risk premium in the discounting factor. The limitations of adjusted rate is difficulty in finding risk premium and risk adjusted discount rate. There is no easy way of obtaining an adjusted rate. Capital asset pricing model offers a basis of computing the risk adjusted rate. Its use has still to pick up in practice. Second, assumption that investors are risk averse is always not true. It is completely rely on the assumption that investors are risk averse. True, it is mostly true. However, a group of seekers also exist who formula of risk adjusted discount rate. As we know that the use of risk adjusted discount rate is based on the concept that investors demands higher return from the risky project. In the earlier video also I explained the same thing. The risk adjusted discount rate is the rate used in the calculation of the present value of a risky investment, such as the real estate or a firm. In fact, the risk adjusted discount rate represents the required return on investment. The risk adjusted discount is the total of risk free rate, that is the required return on risk free investment, and the market premium, that is the required return on the market. The financial analysts use the risk adjusted discount rate to discount a firm's cash flows to their present value and determine the risk that investors should accept for a particular investment. So the differences between the market premium, which is often used as a discount rate in valuation analysis, is that the risk adjusted discount rate takes into consideration the future market conditions, the level of inflation, and the value of money at the end of the investment horizon. Therefore, it is a financial measurement used to calculate the present value of an investment with a high degree of risk. Therefore, NPV is equal to summation NCF, where NCF is nothing but net cash flow, K is nothing but risk adjusted discount rate, I is nothing but initial investment.